Now we have 26 participants, and so I believe we should start this event. Once again, good morning, ladies and gentlemen. My name is Sergey Densov, and I'm representing here tax and legal practice of our Minsk office. During today's event, we will speak about practical cases in application of the double taxation treaty between Germany and respective in-scope jurisdictions. Today we have 4 jurisdictions. These are Belarus, Kazakhstan, Russia, and Ukraine. So we will start from Belarus right now, and in the next 10 minutes, I will describe what are the features of application double tax treaty between Belarus and Germany, what are current approaches of the tax authorities and enforcement practice relevant to the case. And after my presentation, there will be a window with the questions, frequently asked questions, and we will go through these questions and provide clear answers. So let's do it. So here you can see that in Belarus, as in many other jurisdictions, normally the double tax treaty or double tax convention is generally structured based on OECD model tax convention on income and capital. And this is definitely the same in Kazakhstan, in Ukraine, and in Russia, with some specifics. So you see that treaty provisions shall be solely applicable to direct corporate and individual taxes, including property taxes as well. From Belarusian side, these are corporate income tax, withholding tax, personal income tax, real estate, and land tax. Asking the question, what about VAT? Does VAT apply to double tax treaty, or double tax treaty falls under the scope of VAT? No, it doesn't. Why? Because as already mentioned, the treaty applies only to direct individual, direct corporate taxes. So moving to the next slide, we'll see that income from which transactions can double tax treaty be applicable to. For instance, if your company performs works or renders services, provides financing or sales licenses for IP objects to a Belarusian partner or to a foreign company that has permanent establishment open in Belarus, or your German company leases out or sells real estate, has substantial shareholding in local company, then provisions of the treaty can be definitely applicable to each type of income generated from respective transactions that you see on the screen. So moving to the next slide, you see a comparative analysis of tax rates according to the Belarusian tax code and according to incentives or treaty reliefs. So you see that except for royalties, income from leasing out real estate and other assets, capital gains from sales of real estate, all other type of respective income are exempted from taxation in Belarus or could be taxed at lower rate if you will definitely apply double tax treaty provisions. Now we are moving to the next slide, so describing case study scenarios for treaty application in each particular case. So here you can see a real case scenario that we had to deal with some time ago. In the considered scenario, there was no separate fee for software license provided for in the agreement, but respective fee was included into total cost of supplied machinery. The major concern here was that how the German company has to determine a tax base for withholding tax purposes on license fee, or if the tax should be paid on supply of software license. We prepared a number of requests to tax authorities in Belarus, and after 2 years, the following enforcement practice has been established. So no tax is paid on pure supply of machinery. So if the contract provides for a pure supply of machinery, including a license, then definitely no withholding tax shall be applicable in Belarus. In another case, if software is licensed for a fee, then withholding tax on royalties is definitely applies. And Belarusian-Germany double tax treaty provides a lower tax rate, so the income of the German company shall be taxed at 5% rate. And separation of payments and delivery items in the contract is highly recommended, in order that you would not have any issues with the tax authorities when the Belarusian partner would start assessing your income and trying to transfer the income back to Germany from this type of transaction. So here you can see another real case scenario from our experience, where we have the treaty provisions applicable to income derived by GmbH by the German partnership. So the German partnership was providing access to electronic card system to various consumers, to various business partners in Belarus. According to the treaty, income derived by the German partnership is for 100% exempt from taxation in Belarus. In light of above, German partnership arranged for residence certificate. So the certificate was provided by German tax authorities, and the German partnership applied via its tax agents to Belarusian tax authorities, asking for a tax refund, since the tax was already paid by the tax agent. And what was the response of our tax authorities? So it was definitely very interesting. The tax authority responded that according to the Belarusian tax code, exemption under the double taxation treaty can be granted only to income derived by a German partner, by each partner of the German partnership, but not to the partnership as a legal entity. So, and in order to get the tax clearance or get the tax refund from the budget, the German partnership should provide the following documents with the tax authority: the list of partners and the residence certificate for each partner issued by the German tax authorities. And there should be allocation of income to each partner confirmed either by the German tax authority or the German auditor. And in addition, there should be a tax refund application filed either via tax agent or directly by the German partnership. And afterwards, the tax overpaid from the budget can be refunded back. So you see quite interesting approach of our tax authorities, and this approach is currently followed by enforcement practice. So we are moving forward to another interesting case scenario where we have the deal when participatory interest is sold in local LLC by a German GmbH. For instance, according to the Belarus-German double taxation treaty, we have this income taxed at 12% rate. But there is an option to have the tax not paid under the treaty. In order to have this done, GmbH should apply for tax clearance by providing a residence certificate. But what to do if the participatory interest is sold to a foreign company or a foreign individual? So, in practice, such cases are handled in the following way. Withholding tax return shall be filed regardless of whether there is a residence certificate of GmbH at the moment of settlements. For instance, when you get in the funds from the business partner, it is a local LLC who may file a withholding tax return on behalf of company B. And GmbH should ensure providing a residence certificate in advance, for instance, before the share purchase agreement is signed. In case the participatory interest is sold to any company or individual in Belarus, then definitely everything is clear here. And this company or individual would act as a tax agent towards GmbH. And the full tax exemption under the treaty can be granted in normal way, I would say. So we are moving forward to see how the concept of beneficial owner of income is applicable in Belarus. Frankly speaking, the overview of such concept, the meaning of the concept and its application is definitely the same as we have according to international practice. But what important to note here is that according to the Belarus-German double tax treaty, this concept shall be solely applicable to the so-called passive income, which is dividend income, interest, and royalties, not to the full scope of income falling under double taxation treaty, but only to 3 types of income. And Belarusian specific here is that in case the beneficial owner of income, on this slide you see, let's say this could be company A or company B. Yes, and in case the double taxation treaty was not applied to income derived by beneficial owner of income, then company A or company B is allowed directly to apply to Belarusian tax authorities asking for a tax refund. To have this done, you see on the next slide, you see how the procedure currently works in Belarus. So you have to provide either directly to the tax authority or using the tax agent the list of prescribed documents. First of all, you need to justify the legal link between your company and the German GmbH. Yeah, you should prove that you are a real beneficial owner of the income, and afterwards the tax agent will file adjusted tax return based on notification that will be provided to the tax agent after the tax authorities review and confirm that your company, for instance, in our case scenario, this could be company A or company B, is a real beneficial owner of income. So we are moving forward to tax risk management strategy. Here is a kind of 5 tips from our side we specifically developed for your business. So before you're considering any transaction with Belarusian partner, please kindly check the business status of this partner. And of course, if you are from Germany, then there is no need to check if there is a valid double taxation treaty, because yes, it does. We have very good structured double tax treaty between Belarus and Germany. Another option is please ask your tax authority how much it takes to get the residence certificate, and if your company is structured in a legal form of a partnership, for instance, in German, this could be Kommandit Gesellschaft. Then consider specific requirements of Belarusian tax authorities, how to apply double tax treaty provisions. So you need to provide the residence certificate for each partner. You should have description and allocation of income between each partners, and so on. So please also ensure a clear description of type of income in the contract. So if you are, for instance, supplying machinery, supplying various equipment, or you are going to provide services or perform some construction-related works, please consider this as well. In all, let's say, not current cases, or in case of any ambiguities, please consult. And only after you have the clear picture in mind, you can sign the contract and implement the contract successfully for the growth of your business. So here you can see the frequently asked questions we prepared for you. So normally these questions can be applicable to all our jurisdictions that we have today in scope. So asking to the first question, can the double taxation treaty be applicable automatically, or when it can be applied? Our answer is that double taxation treaty could not be applicable automatically. We have to deal with some administrative formalities. For instance, in Belarus, it is the tax agent who should put a specific sign on this in withholding tax return, and to withholding tax return there should be a residence certificate attached, and this is in case then withholding tax is not paid. So when the return is filed and before income is paid to the German company. What happens if particular income is not mentioned in the double taxation treaty? So we have two sections in the double taxation treaty. First one is the so-called business income related section. It is, if I'm not mistaken, section 7. And the second article is Article 20 or 21, which deals with other income sources. So definitely having these two articles, we can handle all the issues if particular income is not mentioned in the double taxation treaty. Answering the third question, if an e-copy of residence certificate accepted, yes, it could be accepted in Belarus, but under specific conditions. You should provide the link to Belarusian tax authority, and the Belarusian tax authority will be able to check the link, to check the certificate, if there is a valid certificate. So if the certificate was really issued by the German tax or fiscal authorities, and that is all. So answering this, the fourth question, so you see that can we obtain tax refund in case of late application? Yes, there is an option. We can obtain a tax refund in 5 years after the tax has been paid to the budget. We need to follow specific procedures. We need to file adjusted withholding tax return along with the tax refund application. And please consider that in Belarus, tax refund is performed in local currency, in Belarusian rubles, and it is only made to the bank account of the company opened with Belarusian bank. No other options available. And yes, there is a technical opportunity to assign local tax representative to deal with your cases. So thank you for your attention. It is last but not least, and here I'm giving a word to my colleague Maria, who will describe current status of double tax treaty application between Germany and Kazakhstan. So Maria, the floor is yours. Thank you.
Thank you, Sergey. Hello, ladies and gentlemen. Thank you so much for joining us today. Could you please kindly confirm if you hear me well? Just putting in chat pluses, if possible, to let me know if you hear me well. Super, I see that you hear me well. In my presentation today, I will cover Kazakhstan-Germany double tax treaty, and I will briefly cover theoretical part, and we will go through the positive things that provides to us double tax treaty between Kazakhstan and Germany. Then we will go through several case studies, and then move to frequently asked questions. Kazakhstan-Germany double tax treaty became effective from the end of 1998. And as you see from this table, for example, services provided on the territory of Kazakhstan, including consulting services that provided outside of Kazakhstan, they are taxed based on Kazakhstan tax legislation at 20%. At that, by double tax treaty provisions, such income can be exempted if certain conditions are met. Interest, dividends, and capital gains are taxed at 15% based on provisions of Kazakhstan tax code. That tax rate can be reduced by the double tax treaty between Kazakhstan and Germany. Here, I just wanted to mention that based on Kazakhstan tax legislation, dividends income and capital gains income, they also can be exempted. We have such rule as participation exemption rule. Under the certain conditions, such income can be exempted as well based on just Kazakhstan tax legislation. Going further, in order to apply double tax treaty protection, a non-resident, a resident of Germany, should provide a residency certificate. It should be apostilled and then translated into Russian or Kazakh language. This resident of Germany should not have a permanent establishment on the territory of Kazakhstan and should be a beneficial owner of such income. Kazakhstan tax legislation provides a definition of beneficial owner, and it states that beneficial owner is an entity that has an ownership rights, usage and disposal rights on such income. It should not be an intermediary entity, for example, an agent or nominal holder of such income. Unfortunately, tax legislation of Kazakhstan does not provide, specify the document by which beneficial owner should be confirmed, and tax authority states that a tax agent should by themselves to identify this beneficial owner based on definition provided in tax legislation of Kazakhstan, as well based on double tax treaty provisions. Before we go into the interpretation of double tax treaty, I just wanted to ask my colleagues from Russia and Ukraine whether their legislation do provide some documents by which should be confirmed beneficial owner of the income. Maybe they can share with their legislation and provisions which may help us as well.
Thank you, Maria. Yes, can you hear me?
Yeah, good.
Yes, thank you for a good question. Actually, a Russian tax code doesn't contain any specific document either. There are just some clarifications from Russian tax authorities and explanations in the tax code what criteria should the beneficial owner meet, and they're quite similar to those that you already mentioned, the criteria, and based on this criteria, the taxpayer should develop the document by himself, and therefore there can be some challenges from the Russian industry.
Okay. Thank you, Nika. Do we have Ukraine?
Maria, can you hear me, see me?
Yeah.
Yes. So in Ukraine, we have a similar situation. Ukrainian tax legislation doesn't provide any specific documents which can confirm the beneficial ownership of the income. However, it is planned to implement the new draft law, which provides several legislations into Ukrainian legislation, tax legislation, and will provide the tax service with additional instrument how to identify beneficial ownership of the income better for them, of course.
Okay, good. Thank you, Sergey. And now let's go further to the double tax treaty. And my colleague Marka will, in several words, tell you about interpretation of double tax treaty between Germany and Kazakhstan.
Thanks, Maria, and welcome also from my side. I have one slide prepared here for you to give you somewhat a basic approach about how we interpret text treaties. This is also applicable for, as Sergei already mentioned, for the other two text treaties that we are talking, Belarus and Ukraine. What is the basic approach? The basic approach is that we have the so-called Vienna Convention. The Vienna Convention is an international multilateral agreement. All the four countries here involved, that means Germany, Belarus, Ukraine, and Kazakhstan, are signing member states of this agreement. In this agreement, basically, there are other parts of this agreement which are not important here, but what is important here is this convention sets up the major rules on how to interpret international agreements, and each text treaty is an international agreement between two sovereign states, so there are certain rules how to interpret them. These rules are basically set in the Vienna Convention. So what then is the specific somewhat rule about how to interpret terms in the text legislation, especially if you have a legislation in Germany which says X and legislation in Kazakhstan that says Y, you may then end up with a double taxation, and this is exactly what the treaty wants to avoid. Then the rule is that each, as Sergei already mentioned, each of the double text treaties has a basis, and the basis is the OECD double text treaty model convention. The OECD has an institute that works on OECD double text treaties. These double text treaties were updated or has been updated regularly. The last one is from 2017, but you have to use the convention that is in place or was in place at the time the treaty was concluded. So specifically talking, when you look at the three text treaties, Kazakhstan, you have to use that, as I've mentioned here, the double text treaty convention 92-95, the same for the Ukraine 92-95, and for Belarus 2003-2005. So there are changes in this convention model text treaties that has to be taken into account, but this is the rule. You have to look at which OECD double text was in force, accepted at the time the treaty was concluded. And there you have not only the double text treaty, the text. There you have a very extended commentary where you can find a lot of interesting interpretations. As for example, as we have talked here, the problem with the concept of beneficial owner. It is included into one of the parts of the commentary to the double text treaty, and there this is the basis where you can go, because normally the rule is that the international rule overrules the domestic rule. So that means in a conflict of interpretation, the double text treaty goes first. The problem is that the double text treaty does not enforce itself on its own. You have to go to court normally and make your case at the court and make sure that the double text treaty is applied to your case. So again, the rule is also with the residency permit. In order to claim any privilege of any double text treaty, you must present your case that you are a person that falls under the text treaty via this residency certificate, and then for specific rules that are conflicting with domestic legislation, then you have to make your case that this is applicable to you. This was in short from my side several words about international interpretation of double text treaties, and thank you very much, and handing back to Maria for going further with Kazakhstan.
Thank you, Marko. In my last part of the theoretical part, I just wanted to mention that Kazakhstan already ratified multilateral convention. It was ratified by President of Kazakhstan on 20th February 2020. And it is expected that from the January 2021, its chosen provisions will be applied already by Kazakhstan and the parties of this convention as well. Let's go further, and we will start with considering case studies. And in our first case study, we see that company A, it is company incorporated in Germany. It's a resident of Germany. Company A provides consulting services to industrial company B, located in Kazakhstan and incorporated in Kazakhstan. As that company A is having a branch office on the territory of Kazakhstan. And here we have the following questions. Is income from consulting services considered as Kazakhstan source income? As I mentioned earlier, consulting services, despite the fact that they are provided outside of Kazakhstan, they are considered as Kazakhstan source income. What entity is a tax agent? Tax agent here is a company B who is paying for consulting services. Who is beneficial owner of such income from consulting services? Company B, which is provided consulting, or company A, sorry, which is provides consulting services, is a beneficial owner of such income. What withholding tax rate should be applied in respect of such income? By Kazakhstan tax legislation, 20% withholding tax rate should be applied at source of payment by company B. Whether Kazakhstan-Germany double tax treaty can help to exempt from taxation such income. Unfortunately, double tax treaty cannot help to exempt such income because of branch office on the territory of Kazakhstan of company A, because it is considered as a permanent establishment on the territory of Kazakhstan of company A. Let's go further and let's consider the second case. And here we have company B, also incorporated and resident of Germany. This company provides a loan to the company C, that company B attracts some funds from financial company A. And here we have the following question. Is the interest income considered as Kazakhstan source income? Yes, interest income will be considered as Kazakhstan source income. What entity is the tax agent? Company C, which is paying interest, is a tax agent. What withholding tax rate should be applied? Interest income is taxed at 15%. Whether double tax treaty can help to reduce tax rate, and here it will depend on the following facts. Whether loan agreement between company B and company C has information about company A. As we see that company A and company B, they are both beneficial owners of interest income because funds of company B and company A are attracted for this loan. So if the loan agreement between company B and C reflects information about company A and company B and contains information about interest income of both parts separately, then provisions of double tax treaty can be applied. In order to do so, what document should be provided? To do so, company A and company B should provide the residency certificates. Then let's go to the next slide. And actually, this is the last case for consideration. Here we have forwarding services, which include international transportation. And here company B, incorporated and resident of Germany, provides forwarding services for company C. And for their forwarding services, they attract company A for international transportation. And here we have the following questions. Whether forwarding services are considered as Kazakhstan source income? If these services are provided on the territory of Kazakhstan, then yes, such services will be considered as Kazakhstan source income. What will be a tax agent for this income? Tax agent is company C who is paying for forwarding services. Who is beneficial owner of income? Company A and company B, both that provide services for company C, they both will be considered as beneficial owner, company A for international transportation, company B for forwarding services. What withholding tax rate should be applied? For company B for international transportation, 5% withholding tax rate should be applied. For company B, 20% withholding tax rate should be applied. Can Kazakhstan-Germany double tax treaty can help to reduce or exempt income? Here, it is important to consider what exactly are involved in the agreement on forwarding services between company B and company C. If the agreement between B and C contain information on parts of income A company and company B, and income are separated in this agreement, then only company B could be exempted from taxation in Kazakhstan. What documents should be provided in this case? For this purpose, company B should provide a residency certificate as well as an extract from trade register, or alternatively, it can provide notary copies that should be legalized of charter documents. Unfortunately, income of company A could not be exempted under provision of Kazakhstan tax code. This is actually all from practical perspective. And now let's move to frequently asked questions. And the most important currently, the question that is asked by our clients is how to provide residency certificate during quarantine time. Based on the information that and clarification provided by our Kazakhstan tax authorities, a scanned copy of residency certificates could be provided in electronic format via electronic gov system, which should be provided in established deadlines. Unfortunately, the deadlines were not extended. And afterwards, when the quarantine will be cancelled, such certificates in paper could be provided to the tax offices. The second question, how to prove that a non-resident is a beneficial owner? As I was mentioned, tax code does not provide a specified document by which the beneficial owner should be confirmed. And here, for example, from a dividends income perspective, we recommend to our clients to reflect the whole structure of the holding, the whole holding structure, and as a good resource of confirmation could be an extract from the register. What is else important is about residency certificate, because residency certificate they usually contain periods for which they should be applied. But in some cases we face when the residency certificates does not contain such period. For this purpose, the client asks what to do if the certificate does not contain such period. For this purpose, Kazakhstan tax authorities clarify that in this case, tax residency certificates are applied for the period for the calendar year in which such certificate is issued. And the last question from our side, do Kazakhstan tax authority provide refunds of withholding tax that already was paid to the budget? Our answer is yes, and they do provide such refunds if permanent establishment was not created on the territory of Kazakhstan, and if residency certificate together with other required documents are available. Our company usually provides such services for our clients, and we already got refund for clients from Kazakhstan tax authorities. This is actually all from Kazakhstan side, and let me pass my words to Nika. She will proceed with Russian perspective. Thank you so much.
Thank you very much, Maria. Let me introduce myself. My name is Nika Slavinska. I'm senior tax expert in Schneider Group Moscow, and today I will tell you about general information on double tax treaty between Russia and Germany, and its scope and some peculiarities of its application. Of course, we'll discuss some practical cases. So first of all, we should have a look at the different sources of law and its hierarchy. Of course, as you may know, international legislation prevails over the national one. And here in the scope of double tax treaty, we would talk about MLI, multilateral convention that was introduced in the frame of point 15 of BEPS plan, base erosion and profit shifting. Maria has already told you about it very briefly, so I will not stop on it in more detail. Just one thing to say that Russia unfortunately has not included Germany in its notification when regarding MLI application. Therefore, Russia-Germany double tax treaty would not be covered by MLI. So then further, we'll go to the treaty itself that was concluded in 1996 and is effective now in the as of date October 15th, 2007. And the national tax legislation is represented by Russian tax code and followed by tax rulings and case law. The double tax treaty covers taxes, direct taxes paid by individuals and legal entities who are residents of either Germany or Russia or both these states. And it's important to know that indirect taxes are not governed by the double tax treaty. For example, I think it was the same as with Belarus, as Sergei said. And the method of tax credit is used by the treaty to eliminate double taxation. That means that income received in Germany, for example, is included in tax base in Russia as well, but then taxes paid in Germany for this income are offset to the profit income tax payable in Russia. Moving forward, let's stop at tax rates and reduced tax rates that double tax treaty provides, and the treaty provides for reduced tax rates for the following types of income. This is dividends, interest, royalty, and capital gains. And of course, in order to benefit from reduced tax rates, taxpayers have to meet certain criteria. If we are talking about dividends, there is certain criteria of stake share that the income recipient should have the least share amount in the income payer. And for dividends as well as for other documents, other payments, certificate of residence and beneficial ownership of income confirmation should be presented to the tax authorities before the payment. The certificate of residence should include all necessary information and has to be duly signed, but no apostille is needed to be effective. And confirmation of beneficial ownership of income should be based on provision of the Russian tax code. Here, the thing is that the concept itself was introduced in Russia by so-called de-offshorization law, but by now there are still no test that is set in the Russian tax legislation. So it is essential to confirm that the income recipient is beneficial owner of this income, but how to confirm it, that Russian tax authorities do not provide it exactly. So first of all, in general, functions and risks of recipients are concerned. As already Maria said, the criteria, as in Kazakhstan, are quite similar. So revenues should not be transferred in transit. The income recipient should not have limited functions or risks and powers to the income received. If this is the case, then these are red flags for the Russian tax authorities, and then he can not count on the reduced rate and the double tax treaty. So we're going further from the beneficial ownership concept in general to its application in practical cases. First case I would like to talk about is loan interests. For example, there is a case that a German headquarter gives a loan to Russian subsidiary, and then Russian subsidiary has to pay interest on that loan. Under double tax treaty, this interest is not taxed, so the withholding tax rate is 0. But here are two things to consider. These are transfer pricing rules on the one hand, and thin capitalization rules on the other hand. First of all, transfer pricing rules, they provide so-called safe harbor corridor, which the tax rate, loan interest rate should fall into. If the interest rate is not in the safe harbor corridor, then the taxpayers should confirm it with the benchmarking study. Then, on the other hand, thin capitalization rules. They consider the concept of equity and loan itself. So not interest rate, but the loan. So interest to equity should be not bigger than 3. So if the amount of interest paid is bigger than 3 to equity, then the excess of this interest will be reclassified in dividends and then taxed at the rate of 15 or 5. Then, but again, the reduced rate should be again confirmed by confirmed by special documents and meet certain criteria. So here I have a question to my colleagues. For example, from Sergey. Do you have in your countries such problem of reclassification of excess interests into dividends?
Nika, thank you very much for this question. Regarding Belarus, we have quite some specific thin cap concept of thin capitalization rules in Belarus. So we do not have such option to reclassify excess of into dividends, but we have a limitation on the side of corporate income tax. So the local entity who pays interest to the holdco in Germany is limited in deductibility of this interest for corporate income tax purposes. So based on this case, we do not have reclassification into dividends in order to get the withholding tax paid at maximum rate. But on the other side, we have a mechanism to reduce high amount of interest payable to abroad. Thank you.
Okay, I see.
So probably we have another case scenario, or how it works in Ukraine. Sergey, please comment.
Sergey, thank you for the question. In Ukraine, we have no reclassification of dividends. Interest into dividends. We have quite different thin capitalization rules. In Ukraine, if the loan amount to company equity is 3 and 5 to 1, then the interest that exceeds 50% of the earnings before interest, taxes, depreciation, and amortization of the company increases its financial results before taxes. So we have a situation quite different.
Okay, thank you very much, colleagues, for your answers. Then let's move forward with Russia-Germany tax treaty. If we're talking about reclassification, it's a very important actually topic in Russian tax legislation. And here the thing that is very important is economic substance of transactions, as there is a risk of reclassification of some deals into dividends, for example, or some other income. So, for example, consulting services or management services agreements can be reclassified by tax authorities into dividends, and then the tax rate, the withholding tax rate, will be applied, not a reduced one, but the general one. And for example, such transactions as loan forgiveness, some shares buyback, or other unreal deals can also be reclassified into other income and taxed at a normal rate of 20 or 15%. That is considered provided in the Russian tax code. If we're going to the next next example, next practical case. Here I would like to talk about tax residency status of individuals. For example, there is a German citizen working partially in a Russian subsidiary of a German company. Taking these two countries, the approach to tax residency status is different in each country. For example, in Russia, a person should become a tax resident if he is actually present in Russia for at least 183 days in any 12-month period. As for the Germany, the center of vital interests, that was what matters. For example, for a German citizen, that's of course Germany, because there his family lives, for example. And then here we have the case of double taxation. Russian employer continued withholding tax from salary payment on his work performed already in Germany, because at the same time he already exceeded this 183 days in a year, and therefore became a tax resident of Russian Federation. But at the same time, German citizen had to pay tax from this salary payment in Germany based on his personal income tax declaration. And we have here one income and which is taxed twicely. There is a possibility to use, for example, the approach of applying tax credit in Russia. For example, the tax paid in Russia by Russian employer is claimed back from the Russian tax authorities, and then the double taxation is eliminated. But of course, it is only a one case, a very individual case, and it is important to know that the tax credit is available only if proper documents confirm that the tax was paid in Germany already, and there should be different other questions and moments be concerned when we consider such similar topics. Then the next question, the next case that I will talk about is about permanent establishment and construction site. Under general rule, permanent establishment is formed in Russia, and therefore the tax paid is in Russia. Tax paid in Russia is when activity exceeds 30 days over 12 months, over a period of 12 months. But for construction site, or for example, assembly facilities of a foreign company, the different period is calculated. Here is not 30 days, but 12 months. So if a construction site operates in Russia less than 12 months, then German company, for example, yes, if it's German company, pays tax only in Germany. So no PE is formed in Russia, and no tax should be paid in Russia. But here is the question: what if a German company is not involved in construction itself, but carries out construction-related works? For example, supervision. How then the PE term is calculated? There is one example of this supervision work when the position of tax authorities provided that the supervision works should give rise to a permanent establishment before 12 months due to the fact that the construction site is under control of another company. So then here the general rules apply, and P is formed after 30 days. And based on the above, it is particularly important to draw your attention to services or functions description in the agreement regulating supervision works or other services provided by a German company on site. And let's wrap up the conversation about the double tax treaty with a positive one. And the positive point is about the German subsidiaries, for example, in Russia, can benefit from the point about advertising expenses. As a general rule, most advertising expenses under Russian tax code are limited by only 1% of annual revenue of company. So only 1% can be deducted as expenses. At the same time, German subsidiaries in Russia have exclusive privilege to deduct a full amount of advertising expenses. No other double tax treaty Russia participates in contains such benefit. But of course, these expenses should be economically justified, attributed to a certain commercial activity, and should have positive effect on the volume of sales or services. If so, then they will be fully deductible for the corporate income tax purpose. And if we're talking about how Schneider Group can help you, these are different aspects of tax and legal consulting. But if we're talking about double tax treaty related questions, so here we can help you to structure your business properly and your transactions in a proper way to minimize tax risks and to apply possibly reduced rate provided by the double tax treaty. We can assist in obtaining residency certificate and determine beneficial ownership of income. And we can also prepare for you proper document confirmation, because we are involved in preparation of such documents for our clients. And this has been already a good practice in our company to help our clients to confirm the beneficial ownership confirmation of the income. So this is all from my side, and I would like to give floor to my colleague Sergey. He will tell you about specific in Ukraine. Thank you.
Thank you very much, Nika. Hello, good day to everyone. My name is Sergey, and I represent tax and legal practice in Kyiv, Ukraine. I hope all of you can hear me and see me well. So we have not much time left. So now we will look at the withholding tax rules applied in Ukraine. I will skip the general part as it has much in common with other countries you have already heard about today, and move forward to the beneficial ownership concept rules which applied in Ukraine. So the beneficial ownership concept in Ukraine represented by two approaches. The first one is so-called token approach, which represented by the provisions of the Ukrainian tax code. This approach says that to identify a non-resident company as a beneficial owner of the income, required to analyze the provisions of the double tax treaty to understand whether the income is liable for the benefits provided by it. Second is provide the respective tax resident certificate, which should be provided by non-resident company to resident company, and translated with apostille and provided to the tax office. So the second approach is so-called essential. This one is not mentioned by existing laws, but has been created by the court case law. It isn't official, however, used by Ukrainian courts in disputes with tax service regarding beneficial ownership. It has been provided that a beneficial owner of the income should not treat it in a narrow technical sense its meaning determined according to the purpose, objectives of international double tax treaties, such as tax avoidance, taking into account such basic principles as treaty shopping. So you ask, what is treaty shopping? In international tax optimization, the term treaty shopping means relocation of a certain type of income to the more attractive tax jurisdiction using weaknesses of the double tax treaties. So the second point in the essential approach says that it has to be direct beneficiary, an entity that obtains an advantage from the income and determines the main here that determines its subsequent economic fate further. So I suggest moving on and looking for some basic cases here. However, before we go, I would like to explain the one important thing for you to know. It's a consequence of being recognized as a not beneficial owner of the income. So if the company non-resident was recognized as non-beneficial owner of the income by Ukrainian tax service, then the resident company will be obliged to pay a withholding tax provided under Ukrainian tax code. Usually its rate is 15%. The amount that should be additionally paid shall be calculated as the difference between the amount that is now need to be paid and the amount that was paid, that has been paid by using double tax treaty rules. So frankly speaking, double tax treaty rules are not applicable in that situation. So moving to the first case, this is about lease. Here you can see that Company A, a cargo ship owner, leased it out to Company B for business purposes. Company B, Germany resident, transferred the cargo to Ukrainian-based Company C. Company C using this C cargo ship and pays for it to Company B. This type of income is subject for Ukrainian withholding tax under the rate of 15%. However, double tax treaty provides an exemption for this type of income, telling that taxation should be held in the country of effective management only. So let's imagine that Company B has the place of effective management in Germany. So by providing a tax resident certificate, we Company C can apply for exemption for this task and not to withhold the taxes from the source income in Ukraine. However, the tax office could appeal here to beneficial ownership of the Company B and point out that the beneficial owner here is Company A, because the Company A is the real owner of the C cargo ship. So you will ask how we could prevent this situation. To avoid such scenario, required to pay attention to contract provision. I will reveal a small secret here that for all cases, contracts play a very important role for all cases that we are going to look at today. So who the real owner of the income and may determine the subsequent economic fate is very important. Be sure that in the contract between Company A and Company B is not stated that the income received from Company C must be transferred by Company B directly to the Company A. So this is the main signal. The second situation, the second case that we have, this case is about the interest. You can see the structure on the slide where the Company A is a financial broker who usually provides loans to Company E and any other similar companies worldwide. So to support its business activity, Company A obtains loans from intercompany loans and issues bonds for fundraising. So the company E pays interest to company A for using this law. So the same as for the previous situation, the income is subject for withholding tax. Double tax treaty between Germany and Ukraine provides for a preferential tax rate at 2%. The double tax treaty says that rate usually it's rate 5%, but for banks and financial institutions, its rate is 2%. So also providing tax resident certificate, company E may apply and use a reduced rate. So here again, the tax service could provide some research. They have a respective legal instrument helping them to receive the required information by requesting it from tax services of other countries. The high risk that the tax office will do some research here and recognize the beneficial ownership for companies B, C, and D because they provided the money, finance to company A, and then the company A is just a transfer company. What parties here can do to strengthen their positions before the tax service? First of all, is pay attention to fundraising terms. They should differ from one to another company. Company A should have no obligation to direct the income of the company E for repayment. It should be general business activity for company A. Company A should bear all risks that connected with interest rates, payment terms, and market conditions. So it's the main measures that should be taken to secure the position. Let's move to the last case. This case is about royalties. So just let's imagine the situation when France-based company A here wants to provide an exclusive license for a trademark to Ukrainian company C. The double tax treaty between Germany and Ukraine actually provides the lower tax rate that provided by double tax treaty between France and Ukraine. So, for example, it was decided that to relocate the intellectual property rights to associated company B located in Germany and then transfer the license to company C in Ukraine. In general, as in previous situations, this type royalties are subject for withholding tax in Ukraine and should be taxed under the rate of 15%. However, double tax treaty between Germany and Ukraine provides another tax regimes for it. So, for example, for trademarks, we have an exemption, but please note that some objects are subject for withholding tax at rate of 5%. So the taxation regime is based on the intellectual property object, so it's need to be considered. So we got another situation there when tax office can appeal to beneficial ownership of the income of the company B and could define the company B as an agent that acting on behalf of company A. So that company B was only created to transfer the income from C to A. Here we need to be accurate with license agreement provisions. Under the license agreement, company B should obtain an exclusive license. What all this means? Usually, tax service doesn't take into account intellectual property legislation. They consider only the tax legislation. But by transferring intellectual property rights under the exclusive license agreement, the rights holder, so the company company A, actually loses its rights, transfers them, and disposes of them for the period of the contract concluded with Company B. So it's definitely clear that Company B is a real beneficial owner of the income here. In conclusion, I would like to ask everyone to remember that all affirmation cases and structures are unique and cannot be applied to all similar situations. Every separate case should be analyzed by professionals, considering and taking into account the business purposes and the certain worldwide business model. So also, I have prepared some frequently asked questions you probably could have from my point of view regarding my presentation. I think, as far as I know, you will have the access to these presentations, so you can look at the answers a little bit later. So that's all from my side. Then I pass on my word to my colleague Sergey. Thank you very much. Thank you all very much for your attention.
Thank you, Sergey, for a very good presentation. So, ladies and gentlemen, I hope you enjoyed our today's seminar. So, let us see if we have any questions. So, no questions so far, but nevertheless, you may address all these to us. We will share the presentations using our business development department, and you are definitely very welcome to join our upcoming webinars. Please see the webinars on our corporate website. So, and thank you for joining our today's event, and stay healthy and see you soon. Bye-bye.